Are we ready?
Yes, sir.
Absolutely. Welcome to another episode of Real Estate Chat with Robert Eid and myself, John De Perez. And the market stats have come out it's November 3 today. October stats
Yeah,
have come
today.
out. No surprises, like, right, Robert? I mean, sales are down, obviously. New listings are down. We're going to touch upon that in a bit. Active listings have surged, but is this supply issue still there? We're going to find out. And the average price has dipped to no surprise. So I'm going to share first the market watch so you can see at a glance, and we're going to link to this in the YouTube description. So have a look at it. This is where we're pulling all of our numbers from, the year over year summary. Robert's going to do a much more thorough analysis of this. So you can see sales there, new listings. We're not going to go into detail with this one. Prices have dipped, but it was coming, and Robert will explain how we saw that into the future based on our previous real estate chat episodes. But Robert,
Yep.
Looking at the October stats, we're going to talk about why weren't they really a surprise. I'm going to pull up your charts here, and we're going to talk about supply issues, and then using all of this information, what somebody can use this information for in making their decision. Let's start with sharing this information.
Sure. Okay. This is the sales, a whole bunch of years all at once. And the trailing along the bottom blue line with yellow stars is the current year, which is the 22nd best October. And it shows us that this October was 41%, 42% below the 10-year average. So it means it's lousy, but everything's been lousy since, what do you want to call it, May? And that it's, if we do another calculation, we say it's about 50% of a boom year. Now, we already knew that. We knew it's not a boom, but it's steady. It's not falling. It was not down to the bottom of COVID. It's just sort of floating around in the 5,000 range. So 5,000 sales means there's people always moving, people always buying, always selling, but there's no urgency, except when there is urgency on an individual property.
And so we mentioned in past episodes that the speculators are the ones that have been taken away from this market because there's always going to be that baseline of people who need to move.
Yeah.
Could that pretty much explain it? And what will we see in terms of sales? And we know seasonality wise, fall sales tend to fall towards the end of the year. Winter sales will be lower than this, but are we going to see this sustained in the next couple of months? And what do you think is going to happen for beginning of next year into the spring market as far as sales concerned?
Okay. Well, you can see it right there. It's an annual arc. And so November is going to be lower than October, big surprise. And December is going to be lower than November, big surprise. Just because there's going to be nothing to stimulate people to change their mind. They're sitting there waiting, doing nothing. They're going to have another interest rate increase and they say, oh, terrible. And you're going to have all bad news in the newspaper. Oh, everybody's going to be talking about the CREA report. Everybody's going to be talking about the Vancouver report. Everybody's going to be talking about the TREB report that comes out and says, oh, 49% off. Okay, so fine. This year's done. Next year, there's two schools of thought. It's going to be a big recovery like 2009, where, oh, gee, what did they do? Drop interest rates like crazy and do all kinds of fiscal stimulus all over the place and budgetary stimulus to save the world in the global financial crisis. Is that going to happen again? Well, no, it's not. They've already determined that they're not going to change their mind on interest rates. Interest rates are up. Now, it's still only 5%, but it's still, they're not going down. And there's no more fiscal stimulus can come on and, sort of save the stock market. So if that's not our year, 2009 for the spring, what is? And I'm going to say that next spring is probably going to be 1990, which is a long time ago, but it's another spring that never arrived. So everybody that thinks that next year is going to be their salvation, they should sell now because it's going to be, not sell now because it's going to be higher next year, we'll find out that they were wrong. However, you can't tell them in the future. Now, buyers, it's a different thing. Buyer is buying one property. So again, you're going to look for something that's perfect for you. You're going to cut a deal on price. You're going to cut a deal on financing. And if the person won't go along with your wishes, you walk. There's going to be another one next week.
Right. And as we see what the price projection, price in terms of where it has moved in the past, we're going to see why the chances of it not reaching this current year spring is more likely because of the fact that interest rates have still gone up. Now, there's one more left for the year in terms of interest rate increase that's expected. And then the beginning of the year, they're going to continue on with whatever policies they're going to implement, but there's no certainty that far into the future as yet. But as for pointing to an increasing or an extreme rise in price and in terms of sales, things are pointing that it may not be what it's usually.
Prices don't go up unless you have 6,000 sales in a month. And if there's not 6,000 sales in a month, prices are not going up.
That's what we got to watch out for. And part of that too is going to be the supply demand part of the equation, which we're going to talk about listings in a bit. But here's the Trev average prices for.
Now, this is the average price, which again, we must state, just like Mr. Corman from Corman and Company said, there's no big houses selling. So the average price is going to come down. This is an average of the average of the price of the houses that did sell. Of the 5,049.61 that did sell, this is what they averaged. So this is what the average price of a Scarborough bungalow is about $1 million, 11.1. It's down from where it was. We knew that. It's flat from where it was. Oh, it seems to be trending to a flat, and it's above where it was 2 years ago, but it's down from where it was 1 year ago, because this fourth quarter of last year was the start of the boom. It started, then it got crazy when you got past Christmas and New Year's. So,
and if we see stability here, Robert, if we see stability here, it'd be fine, right? I mean, it would mean that the rising interest rates did its thing, whatever the government wanted to do. But for the buyer's sake, there's a little bit more predictability in terms of where prices are moving to, right?
Correct. Stable is good, if we can say it's going to be stable. The thing here is that if you take $1,000 of mortgage financing at today's price, just under 1.1, it was $3 per thousand when things were up at 1.35 as a selling price. Now the interest rates have made it so that it's about $6 per thousand. So carrying a mortgage is twice as expensive. So we're not going to have prices because mortgages are twice expensive. Some people don't need a mortgage. Some people have got a 50% mortgage. Some people who are moving have only got a $20,000 mortgage from when they moved in, and they're going to move to something smaller, so they don't need it at all. But the first-time buyer definitely needs a mortgage, and so it's more expensive. Absolutely. So that's where things have been, and then we take from there and we try and guess ahead. Everybody else who's putting out charts is not in the real estate business. They are accountants working for the Royal Bank or TD, and they're saying, based on the anomalies and the stats and the algorithm that we watch, this is what we predict. But one of the most important things that they're watching is fraught with error. And we'll talk about that another day, about the sales to listing do-over rate that's inflating the number that everybody's relying on for supply, the new listing number.
Absolutely. Let's jump to the next chart here, which is this is a bit of a bigger one. I'm going to see if I can flip it to my, to the graphic. So here we go. Robert, you got to explain this one to me.
Okay. So this runs from the bottom of the page up, and the double line, and that's just going back in time. So we have a reference point of where we are. So we go to the double line, which is just about to appear on the top of the screen. It's February. Keep going a bit more. Double line, February 2022. And there's our peak, if this is the peak. So moving up from there is what's happened subsequently. In each month, it's dropped down, then went flat, and then the yellows above are guessing. If it continues to drop at 2% a month, which the average is about 2.08 or something or other from February to now, then, 2.30 is what if you average the 8 months in between the peak and now. So we'll see. But right now, we're about 20%, 18.37% off the peak. So is that flat going to continue? Is it going to go up? What is it going to do? That's what everybody wants to know.
Right. And in terms of determining where that direction is, as Robert mentioned earlier, the average prices depend on the prices of homes that sell. And typically that's going to happen. What's going to happen in the spring is higher priced properties will sell, which pulls that price up. The biggest question is, are we going to see the prices go back to where the peak was in February? Robert, is that likely, or it's almost not even worth asking that question?
We're off by 20% on everything. And I don't care what you say on it, how you figure it, that's the truth.
Fair enough.
You're in a boom, and guess what? It's not sustainable. And so you can't get that money anymore. It's simple.
Yeah. And I mean, that's going to
The
be,
reason that it got forced up, you had 0% money. If you were talking, now the people that took a variable are now in trouble now because the rates have gone up. But if you had in that time, you could get as a variable at 2% or less, sometimes less than, well, less than 2%. And interest rates, or I'm sorry, inflation is officially 2, but really more like 6. Your money is free. So you'd be crazy not to buy a tangible asset with only 20% down.
basically spring prices are not going to hit the same peak as we did. It's going to be a while before we reach those peaks again. And it's
Because
going to be a
consumer confidence, that's the big thing. Supply, demand, consumer confidence is the thing that makes it all go together. This is not the stock market. This is not sophisticated investors. This is mom and pop and where they live. And the easiest thing is to do nothing.
So
And
what
so
you're
if there's
going
no confidence, they do nothing. And if they do nothing, there's no sales. And if the sales aren't there, then the prices don't go up.
to have to wait it out basically. So if you bought at peak February 2022, some of you sold the property and bought, which is like you're basically turning one asset into another. But if that was your first home that you bought at peak, you're going to be waiting for a while before it reaches that price again. So,
well, if I can get very esoteric and make you go, stay to this one. The extreme left-hand side of that multicolored chart is where I took the number of sales, okay, and added them up as we go with a running total, subtracting trade-up buyers, which is about 35% of the market, and subtracting 15% of the market, which is last-time sellers, they're gone, and taking away 20%, which are the specs, which are gone. So that leaves a net of 30%. So all these people that bought at the peak, which I now have up to about 15,000 buyers, they're in trouble because they're going to be underwater. If they put less than 20% down, they're underwater already. But it's not the whole world. It's 15,973 individual customers. And some of those put 50% down. Some of them put all cash from the proceeds from the estate that they inherited. Somebody won the lottery and bought a house with that. So it's not everybody, but it's a finite number. There's 23 million people in Canada and 14 million in the Greater Toronto Area. There's only 15,000 that are underwater. But that's all you're going to hear about in the newspaper.
Yeah, so good point. And let's jump on to here.
Okay. Okay. Now this is a variation on a variation on a variation of Mr. Hogue from the Royal Bank put together all the peaks of the recent booms. We took the peak at July 1981, peak at October 1989, April 08, April 17, and February 22, and lined up all those peaks on a percentage basis. And he did it for a few quarters on either side. I did it first for 2 years on either side. This time, I extended out the year that I think is most approximately the same as the year we've just been through. And I'm going to say that 1989-90 is our best market comparison. And so we watch it for longer. And that's the one that straggles out towards the side of the screen with the blue and the brown dots on it. And what we saw there is after a year, it didn't go down as far as our current market has done. After 2 years, it gone down about as far as our current market has done, because our current market in the red went up fast at the end. It came down almost as fast. So we've been squiggling along at the 80% mark. Now, there's nothing wrong with squiggling along at the 80% mark. We can anticipate is squiggling along and maybe fading depending on interest rates, depending on consumer confidence, depending on the price of oil, gas, all these things that should come out of the consumer price index. If gas goes down, it'll come out of food. If those factors that were actually transitory, that were either forced into the government policy because they were concerned about carbon dioxide is not a bad poison pollutant. You got to forget about that. Anyway, until they get that. So it's not going to change. People are going to continue thinking that way. And so I think we're going to see a trend that flaps along somewhere between 82 and 72% of the peak for a long time. This one shows 7 years.
And I think this is one of those things where you're watching this today, you're just going to have to watch it play out over the next couple of months, over the next couple of years, in terms of where it goes. Because I mean, some of the people who had bought at peak are anticipating, when am I going to get this value back? And others who are buying right now are wondering, if I buy now, will prices continue to keep going down? But Robert and I, in our past real estate chat episode, we looked at the 1990s and what happened late 80s into the 90s, how long that took to recover. And real estate in the long run will recover and will increase. It's a long-term play. It's a long-term move. The most important thing is you're in a house that you want to be in. And let's have a look at this chart where you
So this is
predicted
the projection that we did before the actual announcement of 10,089 as the average price for last mine came out. I was guessing it at 10,075. Oh, I was off by so much. And then projecting, if it falls, continue to fall by 1%, where will we be at the end of next year? So if it falls by 1%, we'll be at 933,000. It falls by 2%, which is about what the average has been. It'll be 810,000 in a year, and worse. So there's your possibilities. Also, again, we looked at this before. You can see that there's a lot of support around that $800,000 mark. Now, 800 from 1.3, that's a huge 40% drop. So I think that's the worst case scenario. Even our perma bear is not calling for more than 40%. So this is where the past doesn't indicate the future. And just because we saw a big drop in the first 4 months doesn't mean we're going to continue to see 3% a month. Maybe it's going to be flat from here on out, but
as you said,
it's not going to be up.
Yeah, and it's about the consumer confidence. So not going to be up, not going to be that much down. It's about the consumer confidence. So the interesting thing about the recent interest rate announcement that was anticipated at 75 basis point came in at 50 basis points.
Yes.
And so what does that mean, Robert? Is that a transition or a pivot in terms of what the government thinks they're doing? They're doing a great job and say, hey, you know what? Let's ease back on this interest rate increase policy. What are your thoughts on that?
Okay, they use code. Pivot is intended to mean change direction completely, go in a different direction. But they're using it as a fudge to say pivot means not go up as fast. No, that's not what pivot means. Pivot means change direction. They're not going to do that. So they're going to try and hit a target. They're not going to telegraph what the target is until they hit the target, because they know that everybody is guessing, second guessing, and betting against what they're going to do on the stock market and the bond market. So let's say in Canada, they want it to go to 4.5. So they're going to get to 4.5. Are they going to ease it up on the way? Well, they're getting an awful lot of bad press. Everything is being blamed on them. Even dear, sweet Justin Trudeau is blaming everything not on him. It's not fiscal policy. It's not economic policy. It's nothing. It's just all Bank of Canada policy. But he controls that stupid thing. So come on. The interest rates were too low for too long. Whoever left them too low for too long is at fault. Everybody else is just living with it.
Absolutely. So last but not least, that was the last but not least, actually.
That was the last but not least. Maybe it's just same thing twice. Conclusion is don't listen to anybody except for your own gut. And if you're trying to sell a house and you think it's going to be worth, be assured that it's going to be less or equal to what it's worth now in the immediate future. Immediate future is 5 years. And so if that means you want to sell it, now you know there's no point waiting for another big boom. And if you're trying to buy something, it's a great time to negotiate. You can, as I said before, get a great deal on price and then get a great deal on financing and buy it when you want to, not when that person wants to. Buyers market now.
Buyers market now. And on that note, if you have any questions for Robert or myself, type it into the chat. Type it into the comments, of what they call it here, and we'll be happy to answer it. Thank you so much for those of you who have subscribed to our channel. For those of you who haven't yet, click on the subscribe button, like this video, and comment on what you think about what we're talking about. And if you have any questions, reach out to us. In the meantime, take care. Bye for now. We'll see you in the next episode of Real Estate Chat.
Real Estate Chat.
Bye-bye.
Bye-bye.